Okay.
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chuck Fuller, Portfolio Manager with Nasdaq Dorsey, Wright, to discuss sector and asset class rankings and if we are starting to see capitulation in the indicators. Chuck, it's great to see you. Welcome back to Trade Talks.
Yeah, great to see you too. Thanks for having me.
And we had this conversation in May. Clearly, we have not yet hit that capitulation point. What are your thoughts in terms of what we're seeing right now in the equity space?
Yeah, I mean, obviously it's a tough environment. Looking at the S&P's June return, if it stopped on Friday, this would be the 7th worst month that we've had since 1957, which is actually the year that the S&P 500 became the S&P 500. It used to be the S&P 90 before that. But, if you look at the other 7 months or the other 6 months, I guess you could say that were roughly as bad or worse, most of the time you were in or around a bottom. When that happened, sometimes you weren't. It kind of depended on, the volatility that you saw. If you were in kind of an October 2008 and, things were going crazy, or March 2020, things were going crazy, you might have some additional downside, but typically you're in or around a bottom when you see it get this bad in a given month. In terms of our rankings, our asset class rankings that we bring up on this program from time to time, we've seen some deterioration in those. The U.S. equities have been able to hold up in those rankings for a while now. Within basically like the last week, we saw U.S. equities move below cash, basically for the first time since March 2020. That's not always a death knell for equities, although that kind of activity did happen before 2008 and before the tech crash in 2000. So it kind of increases the probability that we may see some additional downside. But we are, like you said, we are starting to see some indicators finding the bottom. We have one that we've looked at for years. It's called we call it the TWSPX. It's basically the percentage of stocks in the S&P 500 that are below their 50-day moving average. And that goes, it basically oscillates from 0% at the worst, if everything's below a 50-day moving average, up to 100% if everything's above. And we got down to 2%. So only 2% of the S&P 500 is above their 50-day moving average, which is really rare. Usually you don't get down this low unless obviously we're having a crazy time in the market. Mm-hmm. And there's only been really 4 other times we've seen that in the last 20 years. And 2 of those are kind of associated with, like I said, like incredible volatility. So think, like the latter part of 2008 or March of 2020, even though it feels like we have that kind of level of volatility now, maybe that's well in excess of what we're seeing right now. The other 2 times that we saw it was July 2002, which was a bottom, or sort of a bottom, of that kind of 2000 to 2002 tech market or tech crash. And then, in basically December 2018, this kind of thing happened like basically the day of the bottom, or maybe it was a day removed from it, something like that. Mm-hmm. Regardless, when you see this happen, it tends to suggest that, we're somewhere close to a bottom, especially if you don't have the ball.
And Chuck, if we take a look at the fixed income markets, as you know, having one of the worst starts in a number of decades, what are you seeing there? I mean, clearly responding to what's happening with inflation and Fed policy.
Yeah, right. So, obviously with the inflation print, we saw yields spike much higher. The 10-year getting up to 3.4 and some change. In fixed income this month alone, it's down almost 3%, which typically is an awful year's return. For like the aggregate bond index, we're down like 11.4% year to date. And that's like 4 times the worst yearly return we've seen in like 45 years. So obviously it's terrible. If you look from our perspective, we're kind of trend followers or, momentum traders. Obviously all those trends are bad. There's nothing really good poking its head out, within the space. In terms of our, kind of sub asset class rankings within fixed income, it's definitely weighted more towards the safe end of the spectrum. So things like short duration U.S. Treasuries, inflation protected debt, and municipal bonds. Those are going to be the areas where we're showing relative strength in the space. And on the other end, things like long duration treasuries, more equity sensitive fixed income measurements like preferreds, high yield, things like that are further towards the bottom of the rankings. And my guess is in this space, like I said, we haven't seen any new trends develop to suggest that we're gonna move in the other direction. And I've been saying, hey, there's got to be capitulation in here somewhere in fixed income, but it keeps kind of moving its way down. So my guess is we'll have to see some kind of meaningful peak development inflation to see fixed income catch a bit at all. But it kind of remains to be seen. I thought that might have come this past month, but obviously that didn't happen.
And Chuck, if we take a look at one bright spot within the asset rankings, commodities, of course.
Yeah, commodities, again, they continue to be ranked number one in our asset class rankings, have been for the last few months. We've seen, where most people think of oil when they think of commodities, although there are others. But, when we look at oil, the recession worries have caused it to pull back some. It kind of made a lower top at around 120, where the previous top was 130. It's pulled back to about 110 or so now. On its chart, it would have to move down to about 103 to see it break its upward trend, which goes back to December of 2021. So we're keeping an eye on that. But yeah, overall, commodities continue to be the place to be. I mean, I think looking at the S&P GSCI index, it's up 44% this year, something like that. So, I mean, no other asset class is anywhere close. I think cash is number two, and obviously is basically flat. So, basically what you're seeing is that if anybody has any commodity exposure, that's allowed them to outperform this year. If not, they've had a tough time.
All right, Chuck, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.